Hello, everyone. This is Brian Bortz, one of the partners here at Kane Waters and Associates, and I am bringing you today the investment update for the month of May. As always, I'm joined by Brad Sanders from Tectonic Advisors, and Brad will be joining us here shortly. Unfortunately, this month we are not joined by my partner Hunter Satterfield and the Chief Investment Officer. Hunter was out speaking and spreading the good news of the brand of Kane Waters itself, and so he was unable to make this update, but he looks forward to seeing you guys again next month. I wanted to start out by giving you the performance numbers for the month of May, and man, was it a pretty crazy month. The S&P 500 was up 6.3% in just the month of May. Global stocks were up 5.8%. Bonds didn't fare as well. Pretty muted performance, but domestic bonds were down 0.7%, and global bonds were down 0.4%. So, talking about kind of what happened in the month of May, when we left you guys last at the end of April, we had a lot of volatility. Hunter was famously quoted as saying, "We're just one tweet away from the markets going crazy up or crazy down." And that's really kind of how the volatility has been. Even though a market rebound occurred for the month of May, I think it occurred without a whole lot of clarity on direction and where we're headed. And, I kind of get the sense that most investors and institutional investors have a lot of complacency about what's happening in the world and just kind of waiting to see what the final direction would be. But the fact of the matter is there's still a tremendous number of outcomes that could happen. And really, if anyone's telling you that they know what's going to happen by the end of next month, next week, or by the end of tomorrow, they're probably not being truthful with you. Right now, there's so much uncertainty that it's hard to pick a direction. And when there's uncertainty, the stock market hates that. So to see the rebound that we saw in May was pretty incredible. I will say that I mark it up to a lot of volatility. It was just this type of volatility that we like. It was positive. So with that being said, I'm gonna throw this over to Brad Sanders at Tectonic. And last month's update, Brad had a quote that I want to bring back up as I kick it over to him. Brad, you had said that, man, this might have been the longest month of my career when you were talking about April, maybe other than what happened in 2008. But we've had tariff discussions. We've had earnings season kind of come to a conclusion. We've had the big, beautiful bill and national debt and all this fun stuff. So with all that stuff kind of stewing in a pot, what do you see happening right now in this economy?
Um, yeah, May definitely wasn't as long as April, thank goodness. It's always a lot shorter when the markets go up. Economically, I think what we're going to learn really in earnest starting in late June. So probably by the time, or no, not June, in July. So probably about the time we're talking about our doing our August one of these, we're going to start to get second quarter earnings releases. And I think what you're going to see is a lot of companies delaying guidance or um, foregoing giving forward guidance. And I don't think the market's going to like that very much. And so I expect volatility to continue just because most CEOs are rational people. They're going to respond to business conditions and the most profitable way they can. And as you said, we don't really have any clarity. It's really hard for companies to kind of know what their input costs are going to be 60, 90 days from now. All that has really happened is all these tariffs have been, that the can's been kicked down the road for 3 months. And so at the end of that 90 days, ostensibly, they go back in place unless they delay them again. And if you continue to just delay, and you don't get any deals done, what's the point, right? And so I think you're going to start to see earnings revisions maybe moving a little lower. I think that's already in the market. But I do think you're going to be kind of flying with like very limited visibility as we move into the fall, unless we get a deal with one of our major trade partners, or even a minor one. But if you could get a deal cemented, I think that's going to provide a framework for how other deals will look. And then the market will be able to take that and springboard and start being able to discount more properly. And we can have a market that goes higher. But to me, how this looks, I'm becoming more and more convinced that the bond market is going to determine the directionality of all asset prices for the rest of the year. What we saw in May, to your point, that the broader bond averages were just off a little bit, but you saw the 30-year go above 5% briefly. The 10-year got above 4.6, 4.7 briefly. It's Those are both back down, and actually today we're recording this, whatever this is, June 2nd or 3rd. We had the ADP report this morning that was really soft on new jobs. So you're seeing a 0.1% decline in the 30-year, which is good. But if those yields continue to rise, the Fed is going to lose the ability to kind of control interest rates and monetary policy. Because if you get those yields moving higher and higher and higher, that's basically a voting mechanism by the world saying you're going to have to pay us more for us to lend you money because of your fiscal situation. And then at that point, the Fed cutting rates doesn't really matter as much because the long bonds have kind of gotten away from you. So that's what we're really watching right now. Things are very calm. Credit spreads have come down from where they were when we talked last month. So that's good. But we want to watch the absolute level of those interest rates. If they continue to climb, we could be in a situation where it's going to be very difficult for asset prices to perform. There's just too much debt out there, and you're terming it out at higher interest rates. If we can get a deal done, and you could see those rates really come in, and that would be very helpful. And I really think this big, beautiful bill that you mentioned, that's really when we started seeing yields rise, because Trump ran on a very, waste, fraud, and abuse, and cut all this crazy spending. And that bill adds $2 trillion to the deficit a year. In its current form, it's with the Senate now. So if you see that bill come out and just kind of get rid of a lot of that spending, the yields will come back in. If it passes in its current form, I really don't know what's going to happen. That's just being honest. So we'll have to. We're watching that very closely. But I think really, to me, that's more important than what the stocks are doing day to day right now.
Thanks, Brad. I appreciate that. As I mentioned earlier, I think it's interesting that for the end of April, the year-to-date performance for the S&P cumulatively was down like 5.2, 5.3%, and now we're positive. And you're going to see a lot of volatility like that, I think, until we get some of these resolutions happening from the trade standpoint. And I think that our clients are in a good position. We've positioned our portfolios well, and you believe that our managers are positioned to take advantage of that, correct?
Yeah. Just this week, we have managers that own a lot of steel companies. We had a really fun day on Monday. We had a couple of those up 25%. I really like the way we're positioned here. It may not feel like it in the short term. And I mean, I'm not saying this to be alarmist or anything, but like, we really haven't seen volatility yet. We had a bad month and a good month. People forget, and during 2008, and this is not 2008, so don't take the ball and run with that, but we had 13 bear market rallies that entire time. And just between October and the 1st of January of 2009, we had like a 8-day 12% rally, like a 7-day 16% rally, a big long month and a half long 25% rally, and then like another 5-day 10% rally. So, and we ended up going down to more lows after that. So that's what real volatility looks like. I'm not projecting that we're going to get to that level because we don't have this like credit crisis and our banks aren't failing. But we could definitely see month to month 5% swings. And that would not shock me at all. But to me, that's like commonplace volatility. We're not even really in the trenches yet.
Yeah, and I completely agree. Brad, as always, thank you for your insight. Appreciate your comments. And we look forward to seeing you guys next month when we will be bringing you our June update. Hopefully, my partner Hunter will be able to join us, and we will see you guys then. Thanks.